Greetings and good morning to everyone. Thank you for joining us for today's event. This is the 2023 year-end tax update for technology and life sciences companies presented by Moss Adams. Before we begin with today's content, we have a short video to play for all of you.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And with that, I'd like to introduce our speakers today, Kunaal, Patel, and Bill Sturges. Gentlemen, the floor is yours.
Thank you, Gerald. Good morning, and maybe afternoon to some of you. By way of introduction, I'm Kunaal Patel, tax partner here at Moss Adams. I'm the firm's tax industry group leader of technology and life sciences. I'm joined here today by Bill Sturges, tax partner in our Southern California region. Bill and I serve a range of companies from early stage seed and Series A finance companies to larger cap publicly traded and privately held corporations. Bill, anything you want to add before we jump into the content?
No, Kunaal, thanks. Just welcome everybody and thanks for joining us.
So on our agenda, before we go into any of the technical items and strategies, we will refresh on some industry trends that we've been noticing. We are going to spend some time talking about capitalization of R&D, which I'm sure many of you have had to have dealt with this past year. It's been one of the most impactful legislations that has passed, affecting almost every company in this industry group. We will go over some cash saving strategies and touch on some awareness items as it relates to your income tax provision calculations. Technology and life science trends. We are in a fast evolving age of artificial intelligence, as everybody has dealt with in their personal and organizational lives. AI has been used in all different aspects. Some say by 2026, enterprises that put trust, risk, and security management controls in place with AI applications will increase the accuracy of decision-making at a level where AI technology could eliminate 80% of illegitimate information, which is huge when companies make strategic decisions. Augmented development, or the use of AI technologies such as generative AI, machine learning, is aiding software engineers in what they use to create, test, and deliver applications. It is projected that within 5 years, 75% of enterprise software engineers will use AI coding assistants, and that just as a benchmark is up from what it is around today, which is 10%. huge growth. Democratize AI, the potential to automate a broad range of tasks will boost productivity, reduce costs, and are going to offer organizations lots of opportunities. Virtually, AI is transforming the way all enterprises complete and do work, making it one of the most disruptive trends of the decade. Cyber risk management, also a big deal, protecting information. We've seen a lot of M&A activity recently, not as much as before with evaluations, but a lot of M&A activity. And with the current headwinds on financing, a lot of companies evaluating different methods to raise capital through debt and equity. Life sciences, biotech for the most part has faced truly a challenging year. Revenues normalized after pandemic highs as the COVID vaccines and antiviral treatments, the needs for those dropped. And effectively, 19 and 2021, there was a big boost in biotech revenues. It's leveled out in 2022 and 2023. There are over 20 products representing nearly $200 billion of annual revenue that are expected to lose their patent protection by 2030. The industry is hopeful that continued innovation may stave off the threats of the patent cliffs. However, there's a couple of things that are going on, such as the FTC activity generating concerns that regulation will stifle innovation, largely by restricting the ability for companies to scale through large biopharma acquisitions. FDA approvals have fell over the last 2 years, in part due to the FDA's own staffing shortages. So it's not a lack of patent submissions, but just their staffing shortages. In 2023, all types of biotech financing, whether it was venture capital, debt, financing, IPOs, decreased significantly. Couple of markers, the biotech IPO market fell from 21 to 22 by 93%. And at the start of 2023, 30% of public biotech companies in the US and Europe had less than 1 year of cash on hand. With these headwinds in place, we are seeing a lot of pharma alliance deals on the rise as the industry's preference seems to have shifted towards accessing innovation through alliances and partnerships over straight out acquisitions. One of the challenges with that on these large pharma deals, the value of the deals is the construct of it has an upfront element and a milestone element. And the upfront element where the cash coming in is a small percentage of the overall deal value. Still make it challenging for bios to complete clinical trials and research without consistent funding. Brings us to our first polling question. Did your company have taxable income in 2023? A, yes, we have been profitable for some time. B, yes, for the first time. C, no, we continue to incur book and taxable losses. D, I'm with the advisory side. And one of the reasons for this question is in 2023, working on 2022 tax returns, a lot of companies for the first time, even though they're incurring losses and had revenue, a lot of times found themselves in a taxable income position, making tax planning very important. We've got about 70% of the questions answered. If you want to please respond so you can get your CPE credit. About a third profitable for some time, half continue to incur book and taxable losses. Yes, for the first time. About where I thought it would come out, I thought maybe a little bit more on the second one from what I'm seeing with clients. Good mix. Capitalization of R&D costs, also known as Section 174. Chatter around 174 has been around for a long time. it remains very relevant to all of us. So we do want to share some reminders or inform you if you're new to this topic. So generally, Section 174 governs what cost category are treated as R&D from an IRS perspective. It was amended by the Tax Cut and Jobs Act to include software development costs in the Trump tax reform. For context, the original law was enacted as part of the Internal Revenue Code of 1954. It eliminated the uncertainty in tax treatment for accounting of research expenses and encouraged taxpayers. And the key thing is it encouraged taxpayers to do research and development activities. Under the law before the original 174, expenditures related to taxpayers' expenses generally were capitalized and held in suspense until the taxpayer could either determine the research has failed, or if the research was successful, the taxpayer needed to go through an analysis to determine the useful life with reasonable accuracy to amortize those expenses. There was an election at that time to capitalize this cost and amortize it over a 10-year period. So the new law that was passed in 2017 enacted an important provision that had significant changes to the treatment of research and development expenses. Under the new law, the amount of cost that you pay for research activity beginning after December 31, 21 must be capitalized, amortized over a 5-year period if it was US-born cost. And for foreign research costs incurred outside of the US based on where the activities took place must be capitalized and amortized over a 15-year period. This is a big change for prior law where most taxpayers were immediately expensing their research and development expenses. And what's interesting, this almost in essence is the US is one of the first world countries to, in essence, punish taxpayers for doing research activities, whereas the rest of the world allows the immediate expense. California, where a lot of corporate taxpayers reside, does not conform, but there are states out there that do conform with the federal law. So how do you calculate it? As a practical matter, most taxpayers often start with their financial statement, classification of research and development costs under ASC 730. But there are some differences between GAAP and tax. For example, software development costs capitalized for GAAP under ASC 350 are not the same as the 174 costs that are being captured. So in other words, just using GAAP R&D costs as a proxy for your 174 costs could lead to significant errors. 174 costs generally are the expenses that are in connection with the taxpayer's trade or business that represent experimental or laboratory research. They also include incidental costs to the development of product. As a general premise, what we find in practice is the 174 costs tend to be less than your ASC 730 costs, but may include costs that exist outside of your R&D expense, such as technical support and certain IT functions. There's also a hybrid approach that we see clients take, starting from their Section 41 costs or starting with their R&D study QREs and making adjustments from there. It is important, if you do leverage that strategy, that sometimes in the R&D cost calculation, because it's based on US expenses, doesn't include foreign research, and also contract expense for R&D credit purposes are haircut at 65%. So there are some differences if you're starting from book or if you're starting from a bottoms-up approach from your R&D studies. In practice, there's a lot of gray surrounding 174, so it's important to work with your tax advisor on this. Make sure you're on your same page with your audit firms as well. part of Section 174, you need to be mindful if you have CFCs doing R&D that you may need to capitalize the cost either on the US side with your transfer pricing reimbursements to those CFCs or through the US inclusion of GILTI. And a lot of the analysis really depends where you're going to take the capitalization of those costs on who owns the IP and who bears the risks. Determining where the IP location, oftentimes we look at who has the financial risk or the economic risks to the IP to help determining whether or not the payment should be capitalized on the US side or on the foreign side or through your GILTI calculations. The impacts of IRC on qualified small business stock. For those of you that aren't aware, qualified business stock offers early stage companies and prospective investors an attractive opportunity. Basically, QSBS allows investors to exclude gain from their federal income taxes of up to $10 million when they sell QSBS. There's various requirements such as a 5-year holding requirement, but there's also a test in there that includes the issuing corporation's gross assets, which may not exceed $50 million at any time prior or immediately after an issuance of stock. Now, this $50 million threshold is important with Section 174 because typically what a lot of companies in this industry would look at, they were just looking at their cash or accounts receivable, et cetera, on their balance sheet as a proxy to determine whether they've met the $50 million threshold or they're under the $50 million threshold. But in the current state with expenses incurred in connection with R&D development activities needing to be capitalized, companies need to understand how that might impact their tax basis in these assets, and approaching the $50 million threshold may come upon you a lot faster than expected. So if your company does intend to issue QSB in one or more upcoming financing rounds, you should pay close attention to the impact of the new rules on your assessment of this $50 million requirement. I'm going to hand it over to Bill to go over some year-end cash flow planning.
Thanks, Kunaal. So as the polling was interesting, I would have also thought there might have been a few more that opted in for seeing for the first time their taxable income being positive between the 174 as well as the limits on interest expense that for certain companies is leveraged. And so in any event, within my base, a lot of companies, I do a lot of SaaS companies. A number of them had taxable income for the first time. They still had carry forwards like NOLs and credits, but they're starting to go through those. And so wanted to talk today a little bit about a number of ideas that have been around a while, but maybe haven't been visited in a while because certain industries haven't been running in losses and so haven't needed to avail themselves to those. But I won't run through all of these. I'll hit on a few that I think are more common and have a bigger impact. The general theme on a lot of these is that is what you're trying to do is either defer income, push income off, or accelerate deductions. And a lot of these are known as timing items, meaning that they don't necessarily impact your rate rec. But so it's a question of really when are you going to get the deduction or recognize the income, not if, you will. And so tax and book are not necessarily going to be aligned. Most of the time they're not. The GAAP rules tend to be conservative and are really built to lower your income, whereas not surprisingly, the Internal Revenue Code is designed to try and accelerate income and increase taxes to the government. So these ideas are designed to mitigate those differences. The first one, advanced payments. Is most companies do that. The idea there is that if you have a subscription business, generally for GAAP, that's recognized over the life of the contract. But in tax, you can either recognize it on the cash basis, or you can defer it up to 1 year after the cash is received. The company needs to be on the accrual method, but most companies, again, are probably already doing that. And to the extent that the subscription is 12 months or less, then book will follow tax, and it's pretty straightforward. If you're on a cash method for this particular revenue stream, you can pivot over and do the deferral method. You'd have to do what's called an accounting method change. It's an automatic change. It's fairly straightforward. It just needs to be filed with the tax return. Deferred commissions, I put that one on here. That really, with ASC 606, companies started to amortize their sales commissions over the life of the contract. And so this is one where the tax rules are favorable compared to GAAP. These types of commissions are really compensation commissions and are under the compensation rules. And so as long as those are paid out within 2.5 months, which generally commissions are, then tax can deduct those as the commission is earned. Again, if somebody missed that and they're following the GAAP treatment, then there's an opportunity to accelerate that deduction. Again, if they move to that over a number of years to the book method, then they would have to file the accounting method in order to implement that. Bad debts, the economy's been a lot in the press about where the economy is or is it softening. Generally, the general rule with bad debts for tax is that you don't get to take the deduction until the accounts receivable is written off. So you don't get it earlier. Like for GAAP, typically there'll be an accrual on it, bad debt reserve, but for tax you have to wait until it's written off. Having said that, there is an exception where if you drill down and you look at the individual AR, even if you've not written off that AR, but you can identify the customers and you scrub your AR and you have evidence that it's uncollectible as it relates to a particular customer, then you can take that deduction for tax. Prepaid expenses. There's a number of different types of prepaid expenses. Some of them will qualify for acceleration for tax. A few of the examples of that is going to be insurance. So as long as the duration of the insurance contract is 12 months or less, you can accelerate that up front as it's paid. Business licenses are another one. There's a category that will allow a deduction as paid. There's another category where you might prepay for services. That's on the right there, in the lower right, the 3.5-month rule. The concept there is that if the services or the property is going to be delivered within 3.5 months of the payment, then you can deduct it as it's paid. That one's a little more complicated. It's also an accounting method change, but it's what they call a non-automatic change. So you have to submit a form to the IRS, and you need the IRS to approve it. So it's a more involved change, but to the extent that you are paying for services that are going to be fully delivered within 3.5 months of payment, not year end, but actual payment, then it can be a good one. Kind of going back to the column on the left there, accrued compensation. The one I think sometimes can be a high value impact is bonuses. The general rule on deducting bonuses is that the company's commitment to pay the bonus has to be fixed at year end. It can't be contingent on anything such as continued employment of the employees. And so if they meet that criteria, then they can deduct it as long as it's paid within 2.5 months of year end, they can deduct it. So oftentimes companies are hesitant to commit to paying a full bonus at year end, especially if they require their employees to be there. So a workaround is to pick a number. Oftentimes it'll be a percentage of what the expected total bonus is, say 80%. And if the company documents that they're committed to paying in total a pool to all the employees of X dollar amount, again, it could be 80% of the total, whatever number they're comfortable with. So they pick that number that they're committing to pay, document it by year end, and then that can be deducted. And so it doesn't allocate to any particular employee. It just means that all the employees in the aggregate are going to get paid a certain dollar amount. And that's that's an easy one to do to create a deduction that if the bonus plan isn't otherwise designed to allow that deduction. I'll just go through a couple more of these. With bonus depreciation, we'll cover that slide in a minute. That's throttling down, meaning that only now a percentage of assets placed in service qualify, and that number's dwindling year over year. So people are starting to look at peel back the onion a little bit to see, well, what are some of these other areas in the fixed asset area that I can take a deduction? So repair versus improvement is one. If it's a repair, it's deductible. If it's an improvement, it needs to get capitalized and considered under the general fixed asset rules. Inventory, there are different rules whether you have finished goods versus you have work in process versus raw materials. The rule on finished goods is you can deduct it as long as you offer it for sale to your customers within 30 days. So you don't have to sell below cost, but you have to offer it below cost. So, general obsolescence reserves that you might see on the GAAP books don't translate into a tax deduction. In order to get a tax deduction, if it's a finished good, you need to offer it for sale. If it's a raw material or a work in process, the rules are a little more liberal. And if you can demonstrate that the value's dropped, then you can actually deduct it. Depreciation and cost seg, again, a popular thing in the last few years, especially with the 100% bonus. But we have a group of that they're really former engineers that will go through and they'll look at all the components that go into a build out in a building, and they essentially will recharacterize certain assets that might otherwise show up as a long-term asset, maybe a structural asset, to an asset that has a shorter life, like lighting or carpet, stuff like that. And so that's if there's a build out, depreciation and cost seg is a great opportunity to lower taxes and to hire the right folks to do those studies. 179D studies, those are there's an additional deduction. It's can be as much as $5 per square foot for a new build out, so long as the build out makes the building more energy efficient. And there's certain certifications that will automatically qualify for that benefit. Other times there can be a more advanced. If you don't get the certification, you can do a more comprehensive study and still qualify. I won't keep going. I'm going to move forward. Some of these other ones I think are need a particular fact pattern or more sort of tax technical, which I'll spare the audience on that. But we're going to jump to the next slide. We have a polling question. All right, Gerald, do you want me to read it and you'll run it?
Sure,
I'll
go ahead,
and read
Bill.
it. Okay. What percent of your workforce do you believe will be spending most of their time in the company's office during 2024?
And while we're receiving responses, just a quick reminder, since we've received some questions from the audience, the slide is interactive. So once you locate the answer of your choice, click the answer directly here on the slide and it will record your answer. We'll give everyone a couple more seconds to enter their replies.
So thanks, Gerald. Is it closed now, Gerald, or
Yes.
the poll? Okay, thanks. Thank you, sir. Okay, so it looks like the lower so the question is what percentage will be in the office? It looks like 41% is saying the least amount of people, either anywhere between 0 and 25%. And it's linear as we go down the list. It less and less folks expect more and more people to be in the office. So it's interesting. It's an interesting trend. I know a lot of companies are encouraging folks to come in, but not mandating it. I'm going to move forward, Gerald. Does that work?
Go ahead. Thank you, Bill.
Okay. Yep. Okay. On pivoting now to credits. So wanted to talk more about opportunities to increase your cash flow. So stepping back for a moment, I'm not a credit specialist. So going to kind of start high level here and work our way down. Provide some definitions that'll hopefully give people some framework. There's really generally three types of credits. There are what are known as statutory credits. And the idea there is if you do X, you'll get Y. And those are typically reported on a tax return or some document that you're not expecting a certification or confirmation that you qualify. You generally are subject to audit when you take those types of credits. So you need documentation to support it, but you're not waiting for any kind of approval. So examples of that, the old California Enterprise Zone, work opportunity tax credits. Again, these are situations where you have the right facts and you just take the credit on a return or some other mechanism. Kind of move the next similar to that, except for you do have to get a sort of a certification or some type of approval is the pre-approval or certification type credit. It's very similar concept. It's just that you need confirmation. There's a Georgia tax jobs tax credit that meets that category. The next one is the discretionary credit. This is generally where some type of committee in the government or some committee will review an application and they will grant the credit. These tend to be oftentimes but-for credits, meaning that let's, for instance, say if you're going to build a new plant in a state and you want to get a discretionary credit, the taxpayer, the company is explaining to the committee that I have a lot of choices, I have a lot of options. I will probably go to a different state, but for the fact that you have this credit or grant, whatever it is, and which is going to compel me to stay in your state. So let's keep going. There's lots of different types of benefits. They're not all tax credits. That's the main point on this slide. Some of them are we all think of oftentimes the offsets to income tax, but there are many types of taxes that qualify for various tax credits, whether it be property tax, employer side payroll offsets, to quite a few. There's also just offsets to utility bills. There's grants where you have a certain type of expenditure and you'll get reimbursed for that. And so those types of expenditures can be anything from training to capital investment to jobs. And so a good example is that Kunaal covers employee retention credit. So there's a lot of different types of benefits that one should think beyond just tax credits or offsets. Generally speaking, the bigger the value, the larger the credit, the more planning you'll want to do in advance. And we'll go through some of the triggers here in a second. So you want to get ahead of the game before you commit and things like that to whatever or publicize where you're going to spend your money. A lot of these are publicized. A lot of these are not. There's a lot of credits and grants that the states don't market as much. So there's a lot out there. What are sort of the types of fact patterns that lend themselves to these types of credits? Well, certainly job creation is a big one. And that can be creating new jobs. Those are generally looked on as a net basis, meaning you have to add more jobs than you might reduce jobs. Retention is an opportunity. Training is big. A lot of times states will pay for the training, whether it be at a community college or a training center. They'll pay directly for that training. Some states will even help customize particular training. Capital expenditures is another one. So equipment, research and development is a big favorite. Infrastructure improvement and green energy is big as well. Moving to new markets is big. So if you're relocating or just opening a new office or manufacturing facility, that's a trigger that you definitely will want to think about what credits are available in what markets, because most will have something for that. And then real estate transactions. So again, similar to the earlier one, relocation, expansion, that sort of thing. And again, one of the most important things to do here is to, when you're in the early stages of planning these big expenditures, when you're in those early stages is when to look into these opportunities. What you don't want to do is sign a lease or make an announcement that you're going to move into a particular state, because you kind of have to keep that mindset of but for those credits, I would be in your state. And so you're kind of coming to it from a place where you have options. You haven't committed to anything. So that's how you want to go about pursuing these. Here's just a number of different types of credits that the states offer. Cal Competes has been around a long time. That's a but-for credit, discretionary credit. Sales tax reduction. In California, if you manufacture, when you buy items, you get quite a dramatic reduction in sales tax. So that can be material, and that's broadly defined. That includes R&D type of activities. So if even a software company that might be writing code, a lot of the computers and things that they buy to help facilitate that would be eligible for a sales tax reduction. Texas Enterprise Zone is a refund. That one is based on hiring and jobs, but it's a sales tax refund. So again, the benefit and the cause are going to differ by opportunity. Most of these are discretionary. Colorado's discretionary. They'll refund you up to half the FICA. It's a jobs type credit. The Georgia one, we talked about that, statutory. That's you just need a certification. New York has a couple of opportunities there. One's a offset to your utility charges. That's a fairly easy one, my understanding, to get to. Excelsior Jobs Program is similar to Cal Competes. It's a more competitive program. It's a rebate. Tennessee has a number of credits that are offsets to the franchise tax, often also jobs related, or working within the Tennessee Valley Authority. And then finally, Virginia is also a discretionary credit, and it too is based on jobs and training, and but is also a refund type credit. It's a grant. So unlike Cal Competes, which is an offset to income tax, the one in Virginia is actually they will reimburse certain expenditures for training and hiring. So with that, Kunaal, I believe it goes back to you.
Got one more. This is just here. Do you want me to cover this, or you want to cover?
Sure. Yeah, go for it.
Just a reminder here that bonus depreciation has been around for some time now. It's going to phase down over time. So it's important that if you have a lot of assets that you're putting into place in service, that you're not going to be able to deduct it immediately in the future. Wanted to touch on research and development credits. We could spend a whole session on research and development credits. The key takeaway for the audience here, if you're a technology company and you have engineers in there, there's a whole bunch of activities that could qualify a credit. Life science companies, if you have somebody in the lab, probably doing activities where you can get a federal credit. The way the credit works, it usually works out to be about 10% of the actual spend. So pretty sizable number. Historically, a lot of our clients have deferred putting off research and development credit studies. But in this past year, we've seen a heavy focus on it. I would say because of three things. One, capitalization of R&D costs has pushed a lot of clients into taxable income, and needing to offset any tax after net operating losses has been more critical. Two, from a M&A standpoint, if you don't have the contemporaneous documentation around your credits, whether or not you know they're there, you have a person in the lab doing research, a buyer oftentimes is going to get zero value for those credits. So if you're looking for shareholder value because you have a deal coming up, encourage you to put your sharpen the pencils around doing your research credits. Lastly, we'll touch on the next slide, is there's a payroll offset available. So even if you're not in a cash tax position from an income standpoint, you can save money on your payroll taxes. So the payroll tax offset, it's been around for a while. One of the key things that happened from 22 to 23 is there's been a step up in the amount of credit available. So when you generate your research and development credits, there's an opportunity to elect a portion of that research and development credit to offset payroll taxes. And that has stepped up to $500,000 in 2023. You typically available for 5 years. So almost a $2.5 million of cash tax savings. And the reason why, even though companies feel like they have R&D credits, but need to do the study for contemporaneous documentation, is because the payroll tax election is in the payroll tax regime. So penalties and interest in that regime are a lot more stringent than income tax regime. So for example, if you had a $500,000 payroll tax credit and the service disallowed it, your penalty could also be $500,000. So you could be out $1 million. Some of the requirements in order to get the payroll tax election, there's a gross receipt test where you have to have $5 million or less of gross receipts in the current year and prior years. And also the activities must qualify for the research and development credit. And of course you want to have payroll tax liability, otherwise you're not able to use the offset to offset any tax. Brings us to our next polling question. Have you received employee retention tax credit service solicitations? This is kind of one we put out there. It's interesting, even on the service side, I feel like I get one of these a week, maybe more, from these so-called employee retention credit mills. There's a lot of automated services that have been probing our clients on these. Have about 70% of the responses in. Keep it open for a little bit more. Reminder for your CPE. Click on one of those buttons. Okay, so looks like 3/4 of you have received some solicitation. Good chunk of you haven't heard about the retention credit, so we'll touch upon the credit. So there's a credit that was out there largely when COVID happened for to help companies get through the pandemic. It was based on qualified gross receipt reduction test using 2019 gross receipts as a baseline. So if your gross receipts fell in 2020 quarters compared to 2019 quarters by 50%, you could potentially qualify for this credit. Same with 2021 with a lesser reduction in gross receipts. Or you needed to show that you had a partial suspension of business under a U.S. government order. The credit, a lot of our clients took advantage of it. It's quite sizable. It could be up to almost $10,000 per employee per quarter. So if you do think you're eligible, please reach out to one of your Moss Adams service teams or get in touch with us. We could connect you with our retention credit team. There are some deadlines that are approaching for 2020 credits. the deadline is early next year, and 2021 credits, there's still a year and a half left. On that note, there was a moratorium issued that the IRS is not processing the refunds on the credits that have been filed, largely because of these so-called ERC meals, which a lot of them, those are the solicitations you're receiving to do the retention credit studies. It doesn't mean that these claims, if you have the right contemporaneous documentation in place, will not be refunded to you. We still believe that they'll all be processed, but as the IRS goes through auditing some of those mills claims, they're going to put a moratorium. They also offered a opportunity to withdraw any claim. So if you did a claim through one of these mills and you're uncertain whether you qualify or not, a lot of times due to the partial exemption criteria, there's an opportunity to go back to the service and withdraw your claim. And just further, the IRS separately issued guidance warning taxpayers against using these third-party mills. They've added it to their dirty dozen for areas to focus on, for the agents to focus on audits. Bill, you want to talk about the IRA?
Sure. And also, I just wanted to go back real quick. I think I did on the Calc and Beats. The next window to apply for that starts in January. It's January 2nd through the 22nd. I want to make sure I got that out there. That's a discretionary one where companies, they look to see who's going to increase their headcount or make capital investments. So I won't spend a lot of time on this, but the Inflation Reduction Act was enacted, I think, it was a year ago or so. It's heavily funded, $370 billion. It has a 10-year life. I know there's been some conversations around possibly repealing it. It's a possibility, but if history is any indication, any of the projects that are already started would be grandfathered in. So, but the general idea with these are credits that get generated as a result of folks either building projects that create renewable energy, actually generating renewable energy, or building components that go into projects for renewable energy. Those are the producers, the folks that are the original source, if you will, of that create these credits. They can either consume the credits themselves or they can sell the credits. And then the idea is, so the credits are transferable. Buyers who don't otherwise qualify can go in and buy these credits, and they're going to buy them at a discount as compared to what the offset of their tax liability would be. So there's an arbitrage there. That's why they're buying them. And so again, the concept of a transferable credit for federal tax purposes is across such a broad group of industries is a new concept. The states have had it for a while. So I think it's still getting traction. It's still in the early stages. There's a lot that had to get worked out, but it's something to be aware of. The investment tax credits, those are ones that there's a project behind them. That project is to produce electricity or natural gas or some form of renewable energy. If those credits get transferred, the transferee takes on the risk of that project. Specifically, there's a recapture component to that. And so if a particular project, in order to qualify, it may need to commit to creating a certain amount of renewable energy over the next 5 years. Most of them are purely designed to do that, but if something happens, if they don't meet those milestones, then there could be a recapture component which is obviously concerning to a buyer of the credit. And so in order to address that concern, what the market has done is there's an insurance that comes with them. Typically, the insurance is packaged in when you buy the credit. So to make it easier on the buyer, the pricing right now on the investment tax credits, because it is a market in fluid, it's a fluid market. Right now, we're seeing ones that are insured will sell anywhere between 92.5 to 94 cents on the dollar. So your savings is going to be that delta on your tax. Non-insured credits go for much less, understandably, and we're seeing those priced around the mid 80s. The other type of credit that's transferable is the production tax credit. The idea here is that those credits are generated either when renewable energy is generated, so a solar plant or a wind farm or whatnot that's creating energy, selling it. They can also sell these. They can either use the credit themselves, just like the investment tax credit producer can use it themselves, or they can sell it to a third party. I should also mention on the investment tax credit, you could qualify if you put solar. If you're not in the business of selling it to third parties, but you're generating it, like you have your own solar panels that you put on, you can qualify for the credit and consume that against your own tax, or even sell it if you prefer. So if you're doing some self, for your own footprint, you're doing some things, you could still qualify. Anyway, going back to the production tax credit, they tend to be more expensive. That's because they don't have this recapture component. They're getting generated as energy is getting produced. They also get generated if a company produces components that go into a project that ultimately would qualify. That production of that component is a production tax credit that's not subject to recapture. Because there's no recapture component, they're priced higher. I don't know if you can. I can't see it on my screen for some reason, but it's like 95% or higher is the arbitrage on the production tax credits. And then just these are all negotiable. So you want to be a taxpayer to buy them because they're offsets to income tax. But timing's a big deal when you pay for the projects or the credits versus when you get to use it. Is a big negotiating point. It's an open item. You can contract it however you feel fit. You can do a carryback. If you buy the credit and they're carried back, then you actually will see it on an originally filed return. So, which is usually can be 10.5 months after the year. So if you buy a credit in say June, you may not report it until October of the following year to do a carryback. So you're out of pocket before you save money, and the arbitrage isn't that great. So that's a big consideration: is what's my cost of capital? Does it make sense to me? The deals are somewhat large. You should generally have at least $5 million of tax for these to make sense, and it goes up from there. Keep going here. So this slide here, and again, for some reason on my screen I'm not seeing the whole screen, but this just kind of gives you like a visual of how some of these things can work and the milestones and the cash flow payments. Like a best case scenario, like a dream scenario, is where you are offsetting estimated taxes before you pay for the project. And so the risk on that is that you're going to, you in the first quarter, the second quarter, you are not paying estimated taxes because you're anticipating buying a project at later in the year. the project, the credit applies to the year the project's placed in service. So this kind of gives you a picture of how this could play out. You sign a letter of intent, say in July, it gets placed in service in, say, end of September, and then there's a certification process. You're going to want to make sure the project's certified and insured and everything. And once that's all done, that's when you actually pay it. So your spend is like, here's late November, but you can see from the cash flow down below, it's that the first row there where you see the 2.5 million, that's if you didn't buy the credit at all. The green is the offset, so it reduces your estimated taxes from 2.5 to 625,000. The reason again is the reason there is because these credits can only offset 75% of the tax. So anyway, you move left to right. There's a big spend outlay in middle of December is when you come out of pocket, and then at the end of the day, you've saved 525,000, not million. I'm sorry, 0.25 million is what you've in total spent. Again, this is a great situation. We're not seeing this a lot in the market. People aren't committing to these. I think it's because they're relatively new. It's a new program, and so people are still trying to get comfortable with them. But I think if that doesn't get repealed, I think you're going to hear more and more about them in the coming years. The pricing may change. Who knows what a change in interest rates will have on the effect it will have on the pricing. So anyway, that is the IRA credits, Kunaal, and I will let you
Sure.
take it.
I'm going to go through these next few slides pretty quickly here. As we get into the year end, a lot of companies will be working on their tax provisions if they're public companies or private companies shortly thereafter. Couple of takeaways. We talked about 174 extensively. When you do your tax provision calculations, it's an area of focus from both the preparer side and the audit side. A lot of things to consider, so work with your tax advisors through it. But one of the biggest changes in your deferred tax asset table, typically for companies in this industry, we see a line item for credits, accruals, and net operating losses. But capitalization of R&D is a new line item there that is going to be significant, and companies need to go through an analysis to understand whether or not the associated deferred tax assets for the capitalized R&D impacts the realization of the deferred tax assets on the balance sheet. Also, bonus depreciation can have an impact. Now, bonus depreciation, when it was there, it created a deferred tax liability. As bonus depreciation goes away, the deferred tax liability can change, and deferred tax liability is usually a future source of income for realizing assets. So it's just more important, making provisions more complicated, scheduling will be required. Last polling question, have you heard about the proposed changes to the financial statement disclosures? Gerald, are you able to launch? Is it launched?
It is currently launched. And as a reminder for the audience, this will be our last polling question for this session. Please select the answer directly on your slide. Give it a left click. And we'll give responses a few more seconds here.
As you're answering the polling question, for the audience, in May, the FASB proposed amendments to the income tax disclosures intended to enhance transparency within the income tax disclosure. Through these improvements, they're really targeting how companies, the amount of information that's disclosed in the reconciliation and taxes paid of the companies, the effective dates. If I could advance the slide now, Joe.
There we go.
About 50-50 on that polling question. So the tax disclosure updates, they're intended to be applicable to companies with the fiscal years beginning after December 15, 2024. So there is some time before it's actually effective, and then private companies the year after. But what I wanted to highlight on these disclosures is the amount of specificity that's required. A lot of items that they're using a 5% threshold, but that have a 5% impact on your effective tax rate need to be separately stated. And they're going to use that for both the rate reconciliation, but also taxes paid. So if you owe federal taxes, they want to know the federal, state, the specific jurisdictions of each 5% component of the taxes paid. And put it here a sample of how this change could blow up the rate reconciliation of financial statements. As you can see, there's a lot of disclosure needed, a lot of work that's going to be needed to be done around this, around income tax provisions, which is also already a high risk area for companies and reasons for misstatements. Also, there's going to be some proposed amendments to private company disclosures, just requiring more specific rate reconciliations and other items. Typically, right now, AICPA is generally okay with more of a text disclosure for private companies. Here we're just further highlighting the separate disclosure needed for 5% of income taxes paid. So just the readers are going to be able to see jurisdictions of where the taxes paid are actually going. And on this slide, just, when you look at your company at any stage you're in, there's definitely a tax need or consulting need, and Moss Adams, our services align right in. So please reach out to us if you need help or work with your service provider teams. With that, went a little bit past the top of the hour, so I want to thank you guys all for staying on and wish you happy holidays.
Thank you, Kunaal. Thank you, Bill. As our session concludes here, we have a couple of questions that have been submitted from the audience. We will be answering those directly via email after the session. Those have been recorded and we've taken note of them. Additionally, I will be launching a survey in each of your web browsers right now. Please go ahead and fill this out if you have a moment. Your feedback is greatly appreciated and will help us explore new topics in the coming year, as well as potentially incorporating some positive feedback and changes for our future sessions. With that, thank you very much again, echoing the sentiments from our speakers for attending today's event. And we hope to see everyone at a future Moss Adams webcast in the near future. Thank you all.
Thanks, Gerald.
Thanks,
Bill.
Thanks, Kunaal.